Thank you, Professor Amarpal Singh, Dean, School of Legal Studies, for your kind words. It's my privilege to deliver the keynote address in this webinar on monetary policy and modern banking to the students. I'm delighted to know that Justice Sri Krishna has already spoken to students. Of course, I know his contribution to financial sector reforms. He was a chairman of FSLRC, the Financial Sector Legislative Reforms Commission, and my colleagues worked with him in this commission. And I'm equally glad to know that Justice K.G. Balakrishnan, former Chief Justice of India, will be delivering the valedictory address today. I will be speaking on monetary macro policy responses to the COVID-19 to the students of legal studies today. These are extraordinary times, and these extraordinary times require extraordinary policy response. RBI Governor Shri Shaktikanta Das already mentioned that whatever it takes to deal with the pandemic, we need to do that. So it's uncharted territory of Reserve Bank of India to deal with the pandemic. And over the past few weeks, our hopes for systematically flattening the curve and a quick recovery to the economic activity, whether it is U-shaped or whether it is V-shaped, all started to fade. And we responded to this crisis by announcing a great lockdown strategy. It's basically through social distancing, quarantine, but this has triggered an enormous economic disruption and a mounting humanitarian crisis. And now evidence is mounting, pointing towards a major crisis, a dual crisis, which is a public health crisis and a macro financial crisis. And on both demand and supply side conditions, not only in our country, but beyond. And this is basically a human tragedy, how the central banks can respond to this crisis. And to me, we can focus on two things. One is the measures related to economic firefighting. That is, how to ensure the liquidity infusion into the system and how to stabilize the market reactions. And second, of course, we can float the medium-term reforms. And this crisis is like no other. When the crisis is like no other, we need to respond with the policy package also like no other. And this macro uncertainty we face, it's hard to measure. And let me explain to you a bit of what US Fed Reserve has done and European Central Bank has done, or how they responded to the crisis, before I explain to you the pandemic economics of RBI. A day back, I was interacting with Professor Janet Yellen, former Fed Reserve Chair of US. I met her in Atlanta last year when I was attending or presenting my paper in the American Economic Association meetings. And it's always a learning experience talking to Professor Janet Yellen. So in our recent email exchange, what she mentioned is that she's fully supportive of everything Jay Powell, the Fed Reserve Chair, has done, and how central bank has responded to this crisis in US by basically lowering the interest rates to effectively zero, by engaging in unlimited asset purchases, and also by establishing emergency lending facilities to keep the credit flowing to the households and the business. And in US, in the flexible interest target regime, inflation targeting regime, these policy measures are very significant because their unemployment is at Great Depression levels. And the inflation has consistently undershot Fed's 2% objective. And it's almost for a decade. And now it is under downward pressure. And Professor Janet Yellen mentioned that the standard monetary rules would call for a short-term rates of -10 to -20% if it were possible, and all these policy announcements with regard to the pandemic could certainly fill that gap. Now, let me talk to you how European Central Bank has responded to the crisis. Christine Lagarde, the president of ECB, mentioned that The ECB is determined to use the full potential of all the tools available within their mandate. And how ECB responded to the crisis? Basically, by calibrating the Pandemic Emergency Purchase Program. And this Pandemic Emergency Purchase Program, it's a non-standard monetary policy tool. They initiated this in March 2020. The aim is to counter the serious risk to the monetary policy transmission mechanism. And if you read the details of this emergency purchase program, it's basically a temporary asset purchase program of both private and public sector securities, and it's within an overall envelope of around 750 million euro. And how this COVID crisis will permanently shift the economic structures, like both within the country and across the countries, that's highly uncertain at this moment. And it all depends on the nature and the severity of the shock, how all these structural shifts are going to happen. And in this uncertain environment, all what monetary policy can do is to do a proactive stabilization role or stabilizing role. And in India, the great lockdown was announced by our Prime Minister on March 25th, 2020. Subsequently, an economic package, both fiscal and monetary, was announced in our country in an iterative manner. And I'm focusing on the monetary policy package in today's lecture. Fiscal policy I'm not dealing with in today's lecture. So if you look at the monetary policy stance, can you appreciate that there is a policy transition that has happened over the years from discretion of the RBI governor to the rule-based monetary policy stance? Over the years, we have reached a new monetary framework based on the inflation targeting. And this was basically done in February 2016 by an agreement between the Government of India and RBI. They entered into an agreement which states that the primary or the sole objective of the central bank of our country is price stability, nothing else. And there were debates regarding the central bank independence, but all what the independence we seek is just the operational independence through constituting the Monetary Policy Committee. So instead of RBI governor taking decisions, now there is a Monetary Policy Committee that take decisions regarding the monetary policy stance of our country. So earlier, it was like RBI governor, announcing the repo rates, the policy rates, and the other kind of liquidity infusion in our country. But now this decision, through this operational independence, it's taken by a Monetary Policy Committee, MPC. So it's not basically the goal independence what we are talking about. It is price stability, which is our goal. But all what we can seek, that independence is only operational independence. Okay, having said this, the students of legal studies, you may be, interested to have a look at this MPC minutes. As per the section 45ZL of Reserve Bank of India Act 1934, Reserve Bank has to publish on the 14th day after every meeting of Monetary Policy Committee the minutes of the proceedings of the meeting. Whatever resolution they have adopted in the meeting will be uploaded in that document, and the voting pattern of each of the member of the Monetary Policy Committee will be revealed in that minutes, and also what is a statement they have taken regarding the policy rates and other related measures will also be announced in that minutes. So this is an important document for research, and this is that interface between the monetary policy and the legal fiat. It's very interesting for you students to have a look at that, and don't miss that from this point forward. I do highly recommend that you should have a look at it. And currently, who are the members of our committee, the Monetary Policy Committee? We have, many academicians in this committee. Chetan Khate from ISI, he's a professor in the Statistical Institute. We have Dr. Pami Dua, the former director of Delhi School of Economics. We have Ravindra Dholakia, the former professor of Indian Institute of Management, IIM, Ahmedabad. And of course, we have the executive director, because that office of RBI nominated by the central board, under that section 45ZB2C of the RBI Act 1934, Dr. Janak Raj, the executive director, will be attending the meeting. And of course, the deputy governor, Michael Patra, and the governor, Shri Shaktinder Das. So, all what they could do is the decision on related to the policy rates, it was unanimous except for Chetan. So if you look at the voting pattern, only Chetan Khate's voting pattern was different, but all others were in sync. And another important thing I want to flag is that this Monetary Policy Committee, they looks into the inflationary expectation survey and the other kind of forecast and the projections done within the RBI, the team by the professional forecasters regarding growth, that also is looked into, and the internal and the external environment will be analyzed before they come to a conclusion whether they will have a policy rate which is status quo, or whether they are going to increase the policy rate or decreasing the policy rate. So basically, the central bank respond to an economic situation through decreasing or increasing or maintaining the status quo of the policy rate, and by inducing the liquidity, or by the other way around, depending on the liquidity situation of a particular country, and basically the regulatory functions with regard to the monetary policy stance. So these are the different ways in which a monetary policy authority responds in normal times, and in crisis time, it's an uncharted territory. So what they have exactly announced in the context of pandemic, let's have a look. And all what that has happened in the Monetary Policy Committee decision is to reduce the repo rate under the liquidity adjustment facility by 40 BPS to 4%. So it was earlier 4.4%, which was announced in March. In May, they have further reduced to 4%. So our repo rate is now 4%. And what exactly is the repo rate? The repo rate is a rate at which the banks borrow funds from the central bank against the eligible collateral. And what happened to the reverse repo rate? The reverse repo rate is a rate at which the banks place their surplus funds with RBI, also under the liquidity adjustment facility. And these reverse repo rate and repo rate were introduced only in June 2000. And from that point forward, this repo rate emerged as the key policy rate, signaling the monetary policy stance. Okay, and the next announcement was related to the marginal standing facility. And the marginal standing facility is nothing but to meet an additional liquidity requirements, banks can borrow overnight the funds from the RBI. But that will be at a higher rate of interest. And that's basically we call as a marginal standing facility. Normally, this MSF rate, it's like 100 basis points above the policy repo rate. So the banks can borrow against the excess SLR securities, and they're permitted to dip it down to 2 percentage points below the prescribed SLR to avail funds under the marginal standing facility. So if you look at the pattern, you can see that the banks are investing above the statutory liquidity ratio, or that's happening in our country, because one argument is that the banks want to play safe, that they're investing in 100% gilt and 100% safe instruments, and another school of thought is that there is no demand in the economy, so how this lending or the credit operations will work, and the non-food credit is coming down because there is no demand in the economy. So there are two schools of thought regarding why the banks are investing above SLR requirement in our country. Basically what Monetary Policy Committee have decided is to continue with the accommodative stance as long as it is necessary to revive the economic growth and also to mitigate the COVID pandemic. And they also ensured that the inflation remains within the target. So these decisions were taken with the objective of keeping that medium-term target of the CPI, and that is 4%, within the band of plus or minus 2 and supporting economic growth. So that's the way it has been done. So it's basically your policy tool here is the repo rate, but it's always a question you can ask, like whether monetary policy stance is very relevant or very significant to mitigate the crisis, or is it the fiscal policy dominance that matters and we need to go for a fiscal policy stimulus. So which is like relatively more significant? That's a research question, and we can take it up in the the question answer session later. And you can also ask a question within the monetary policy stance, infusing the liquidity is a right approach, or whether you are able to mitigate the pandemic by using your policy tool, the repo rate. Because if you look at the price stability, which is the sole criteria or the sole function of RBI in our country, even that price stability, that's not completely a monetary phenomenon. You have supply chain shocks and many other things you need to deal with to control the inflation itself. So, my question is it relevant to have a relook into the new monetary framework of our country against the backdrop of pandemic? Okay. And what exactly happened regarding the liquidity infusion in our country? What exactly RBI has done? I remember the Operation Twist. It's a kind of auction that has happened. It's like simultaneous sale and purchase of government securities, and I think it happened in April 2020. And this is to distribute liquidity more evenly across the yield curve. And this Operation Twist was the beginning of this liquidity infusion. It's like you are basically playing with the maturity structure of your bonds by infusing more long-term and selling away your short-term bonds. So that's what's called the Operation Twist. And there were other kind of tools which were introduced in our country to infuse the liquidity. And I'm not going into the details of all those instruments. What's coming to my mind is that 5.66 lakh crore which they announced in May 2020 using under that liquidity adjustment facility. And also they have injected around 1 lakh crore through the open market operation purchases, and they also use the targeted long-term repo operation auctions, and around 87,000 crores where that liquidity was induced through that. So basically what I'm trying to tell you is that there are different kind of or the methodologies in which liquidity was infused in our system. That's the way they have done that economic firefighting methodology by the central bank. But as long as the demand is not stimulated, whether this inducing liquidity in the system, whether that works well, that itself is a research question, and we can take it up later. Okay. And regarding the inflation, that outlook is highly uncertain, and economic activity it's at the rock bottom, and RBI is predicting a negative quadrant in the coming days because of the social distancing measures and the temporary shortage of labor. All these things can create enormous economic disruptions, and the macroeconomic impact of the pandemic, that itself is quite a difficult exercise to do, but with certain assumptions and all, this RBI and the North Block has come up with the a few numbers, but the North Block is quite, comparatively, what do you call, optimistic about the rate, that they have not predicted any negative thing, but RBI has predicted a negative growth rate. And now let me get into the second part of my lecture.